All right, let's jump right in. We're going to talk about a really powerful tool, one that a lot of people kind of sleep on, actually. It's called the put-call ratio. I mean, think about it. The market is it's pure chaos, right? It's all fear and greed and millions of people making decisions all at once. So the idea that you could boil all that noise, down to just one number, it sounds pretty wild, doesn't it? And that's exactly what this ratio tries to do. Now, look, it's not a crystal ball. Nobody's claiming that. But it's probably the closest thing we've got to a real-time fear gauge for the market. It gives us a snapshot of the collective mood. Are people feeling optimistic, or are they getting pretty pessimistic? And the way it works is, at its core, super simple. It's just comparing two different kinds of bets. It's asking a really basic question. Are more people betting the prices are going to fall, or are more people betting that prices are going to rise? That's it. This ratio just gives us a score. Okay, so before we go any further, we've got to get on the same page about what these two things are. Let's break down the two pieces of the puzzle, puts and calls. This is actually easier than it sounds. A put, that's your right to sell something. The best way to think about it is like an insurance policy. You buy it when you're worried prices are going to drop. And then you have calls. A call gives you the right to buy. This is your ticket to the moon, right? It's what you buy when you think prices are going up. So puts are for gares, calls are for bulls. Simple as that. And the math behind this, it's almost laughably simple. You literally just take the total number of puts being traded and you divide it by the total number of calls. Boom. That's it. That little number that pops out is our sentiment gauge. All right, so we've got a number. Now what? What is this number actually telling us? Let's get into how to read the basic signal. So your first instinct might be to think, okay, a ratio of 1.0 means it's perfectly balanced, right? Equal puts and calls. And that makes sense, but it's not quite how it works in the real world. See, the market naturally has a bit of an optimistic tilt. People are generally betting on things to go up. So there are almost always more calls being bought than puts. That's why the neutral or average baseline isn't 1.0. It's actually closer to 0.7. With that 0.7 baseline in mind, the first layer of interpretation is really easy. If the number starts climbing above 0.7, that means more people are buying those insurance policy puts. Fear is on the rise. And if the number drops below 0.7, well, that's greed taking over. More people are buying those tickets to profit calls, expecting a rally. Okay, that's the simple version. But now we get to the really fun part. Because just reading the number at face value, that's only half the story. The real power, for a lot of pros, comes from flipping the script and thinking like a contrarian. And this is the million-dollar question you have to ask yourself. Because what does history tell us? It tells us that when everybody agrees on something in the market, when the crowd gets completely convinced that things are going one way, that is often the exact moment the market turns around and does the complete opposite. And there's a pretty brutal reason why this happens. Let's be honest, trading options is hard. Something like 90% of people who buy them lose money. It's just a fact. So if you see this huge stampede of people, the crowd, all making the same bet, and you know that crowd is usually wrong, well, that should set off some alarm bells, right? It might just be a giant flashing sign to consider doing the opposite. So here's the contrarian playbook. When that ratio goes to an extreme high, we're talking above 1.2, that means panic is in the streets. Everybody is terrified. The contrarian looks at that and thinks, maybe the fear is overdone. This could be a buying opportunity. And on the flip side, when the ratio gets super, super low, like below 0.6, that's when everyone is greedy and complacent. The contrarian sees that and thinks, uh-oh, the market's getting way too frothy. Maybe it's time for a reality check. And this isn't just some abstract theory either. This has worked in the real world. There was this legendary investor, Martin Zweig, and this was one of his go-to indicators. Just before the massive 1987 crash, Black Monday, he noticed the put-call ratio was at rock-bottom levels. Everybody was euphoric. There was no fear. And for him, that wasn't a good sign. It was a massive red flag. And, well, he was right. Okay, so huge disclaimer time. Before you go and mortgage your house based on this one number, we need to talk. This is a tool, not a magic wand. You have to know its limitations. So let's run through the essential caveats, the things you have to keep in mind. First, big institutions can skew the numbers. They buy tons of puts just as a hedge, like giant insurance policies, not because they're betting on a crash. That's why a lot of traders prefer the equity-only version of this ratio. It filters some of that noise out.
Second, just because the ratio is extreme doesn't mean a reversal is coming tomorrow. Fear and greed can stick around for a while. Third, context is everything. You have to ask why people are scared or greedy. Is there a big Fed meeting, an earnings report? And finally, and this is maybe the most important one, never use this tool by itself. It's one piece of the puzzle. You've got to use it with other indicators like VIX to get the full picture.
So at the end of the day, here's what it all comes down to. The put-call ratio is an incredible tool for one thing. It tells you with amazing clarity what the crowd is thinking. It tells you if there's fear or if there's greed. But the one thing it can't tell you, the billion-dollar question it leaves right at your feet, is whether this time, just this once, the crowd might actually be right.